So now, imagine you're a businessman. You meet somebody who agrees today to buy your crop 6 months from now at a fixed price. Done deal, right? Everything's safe and secure, right? But wait, what if that somebody suddenly disappears in 6 months? What if it's because he promised to buy your crops at, say, $450 per 5,000 bushels? But now, prices are only at $360 per 5,000 bushels. Here we might be talking about thousands of reasons to run away from the contract because the contract amounts to thousands of dollars in losses. Well, that's the world of forwards. And this is exactly why futures contracts are actually perfect to address these real issues. Today we're breaking down what futures are and how futures solve those problems, how they work for hedging, and because of the way futures are built, as you will find out later, how they can be used even for investing and speculating. In my years of teaching derivatives in a university setting or for CFA review exam preparation courses, I've had the opportunity to teach forwards and futures to students, and as a result, I got a lot of feedback from their point of view, that is, from a newbie point of view. There's so many different kinds of futures contracts, from commodity futures to financial futures, and it can be dizzying and confusing to a beginner as to where to start, what to focus on, and how to study them all. So today, we will simplify things and get to the heart of the matter, learning things that you can then extend to particulars by mastering the general matters first, all in this bootcamp. So stick around. The problem, what's wrong with forwards? Well, a forward contract is simple. Two parties agree today on a price, delivery happens in the future, it's private and customized, and they are traded over the counter or OTC. Sounds great, right? Well, here are the major issues. Number one, counterparty risk. If the price moves a lot, one party has a huge incentive to default. For example, you might agree to buy oil at $70, but the market price becomes $100 now. The seller might walk away because he's better off selling oil in the market rather than selling to you. So there's no guarantee the contract will be honored, and contract law will have to be the main recourse, which takes time and can be expensive. Number two, illiquidity. Forwards are customized. They are private agreements. Because they are customized, what suits one might not suit any other. Imagine having a customized suit made with your tailor versus buying an off-the-shelf suit. Which one do you think has a higher chance of being resold as is? The one is more generic, right? Because it might fit a bigger number of people versus a customized suit that might fit only you and a smaller number of people, especially if your suit is overly customized to your tastes and needs. This means that since forwards are customized, you cannot easily sell or trade your contract away to somebody else. So you're stuck until maturity. Number three, lack of transparency. Prices aren't publicly quoted, so you don't know if you're getting a fair deal, and there's no centralized price discovery. Number four, no interim settlement. So all gains and losses are realized only at maturity. That creates large sudden losses, and there's credit exposure building over time. The solution? Futures. A futures contract is basically a standardized forward traded on an exchange. Key idea here is that the futures will fix the major weaknesses of forwards. And how does a future solve each problem? Let's map it out. Number one, counterparty risk. There's a clearinghouse guarantee. In futures market like the Chicago Mercantile Exchange, you don't trade directly with another person. You trade with the clearinghouse. The clearinghouse becomes the buyer to every seller and becomes the seller to every buyer. This eliminates counterparty risk. Note, instead of saying buyer or seller, the words long or short are used because technically you're not yet buying or selling the futures right now. You're merely positioning for buying or selling in the future. So try to get used to it. Long is the future buyer, short is the future seller. Number two, liquidity. We have standardization plus exchange trading. Futures contracts are standardized. There's a fixed contract size, there are fixed expiration dates, and there are standardized assets. This allows easy buying and selling and deep liquidity. You can exit anytime before maturity. Number 3, lack of transparency. Well, you got public price discovery because of the exchange. The future will trade on exchange, so prices are visible in real time and markets are highly transparent. Everybody sees the same price. So number 4, the problem of no interim settlement, there's a mark-to-market system in futures. This is the biggest innovation. Futures are settled daily, not just at the end of the contract. This process is called mark-to-market. What happens is that gains or losses are calculated daily and then money is added or deducted from your account called a margin account. Let's talk more about this margin system. How does this margin system work? First of all, there's always a standard contract size that depends on the underlying commodity or asset on which the future is based. To simplify things, let's assume a hypothetical widgets futures contract that delivers 100,000 widgets per contract, and the price is currently at $10 per widget. So if you long one widget's futures at $10, you are in the hook for $1 million, or $10 times 100,000 widgets. This means that at maturity, say in 6 months, you're supposedly going to buy 100,000 widgets at the price of $10, and you need to pony up $1 million by then. However, right now, in order for you to be good for the trade, you need to put in a margin as some sort of collateral, say 20% of the position. Although in real life, it's way below this, but we're just using nice round numbers in our example. In this case, you put up to 100,000 to open the position. This is called an initial margin. Now, the clearinghouse will require that you maintain a minimum margin account because depending on your daily mark-to-market positions, the net gain or loss for the day gets reflected in your margin account for that day. That is, there are actual cash or credit movements intraday or end of day, reflecting your mark-to-market positions on your margin. So these are not unrealized gains or losses in your books because they are always realized daily via the margin account. So if you lose or gain 10% on the futures price, that immediately gets reflected in your margin account. So if you've been on a losing streak, your 200,000 margin might be suffering substantial losses and wouldn't be allowed to go below a minimum account balance. Let's say that that minimum balance is 150,000 for the sake of argument. So that would be called the maintenance margin, which is the minimum balance required to maintain your 1 million futures position. Now, what happens if your margin account falls below the maintenance margin of 150,000? Then a margin call is issued and you have to top up your margin back to the initial margin of 200,000. Again, if your balance falls too low, you get a margin call. The top up due to the loss here is actually called a variation margin, which are actually the P&L movements reflected in the daily margin accounts. This ensures that the daily mark-to-market positions get reflected in your margin, and that guarantees performance, especially if you get a margin call. In the face of such margin calls not being fulfilled, the clearinghouse will close the account and settle the futures contract immediately, not allowing therefore any default risk to happen. So how this operates. So let's say you're long one futures contract at 10 for 100,000 widgets. This is the notional position, 1 million. The initial margin is 200,000 and the maintenance margin is 150,000. Now, at the end of the day, the futures price drops to $9. What happens? So before we get into that, try to remember this. For long positions, you gain if prices go up and you lose if prices go down. For short positions, you gain if prices go down and you lose if prices go up. Alright, well, just think of stock markets. If you buy at 100 and sell at 110, meaning prices went up, then you gain $10. So you gain when prices go up. The analogy for futures is this. If you are long, then you are buying in the future at 100. If prices go up at 110, then the futures will subsidize the difference so that you end up buying only at 100, even if prices at maturity are at 110. That is, you fix the price at 100 at all times. Again, think of stock markets. If you buy at 100 and sell at 90 this time, then you lose $10. So the analogy here is this. If you are long at 100 and prices go down to 90, you're still forced to buy at 100, even if it's just 90 in the market. That means you pay the $10 difference to ensure that you're still good for the contract. That is, you are locked in at the price of 100, even if the futures price now, which is presumably the price at maturity if nothing changes in between, is 90. Now, this might need some getting used to. So for now, I'll give you another example. If you watched that classic movie called Trading Places, starring Eddie Murphy, his character was trying to make money in the futures market by trading orange juice futures. The whole idea is that the futures price was going up because people were led to believe there was a shortage of oranges. So they bid up the prices, or the market was long, or in short, they were buying. The Eddie Murphy character, knowing full well there was no shortage, waited until they hit really high prices and suddenly shorted the market at top prices. So they were essentially selling now at high prices. Then when the news came out that there was no shortage of oranges, the market quickly reversed and bid down prices, reaching lows. And that's the time the Eddie Murphy character decided to long the futures. Get it? So what just happened? They went short at highs, then went long at lows. You can think of them as essentially selling at high prices, then buying later what they needed to sell and buying them at low prices, pocketing a tidy profit. Sell high, buy low, meaning short at high prices, long at low prices. So if you're short, on the other hand, you expect prices to come down and make money if prices do come down. So if you're long, on the other hand, and prices went down, you lose money. The latter is buying high, selling low. Long at high prices, short at low prices. So that's a losing position. It's like buying at high prices and selling at low prices. Long at high, short at low. Notice that basically you can close your position by doing a reverse trade. If you short, then afterwards you long the same amount of contracts and you close down the trade. Or if you're long, then afterwards you short that position. That closes the position as well. So in futures market, reverse trades are the majority of how positions are closed, with only a small portion actually taking or making delivery. In the movie, prices went down as the markets tried to close their losing positions by shorting the same amount of contracts they were long on earlier that day. Okay, back to our example. So here the price drops to $9, and since you were long at $10, you need to pay the exchange 10 minus $9 times 100,000 or $100,000 from your margin account so that you can transfer that to whoever is the short of the position. So the notional position looks like this. This is the initial margin, and the payout is 100,000. So you're going to take out 100,000 from your margin, so your margin balance is 100,000. However, this is already below your maintenance margin of $150,000. So a margin call is issued because of that. Now you have to pony up a variation margin. In this case, it's 100,000. It's the P&L to top up your market back to 200,000, meaning you lost 100,000. And now, since you're below the maintenance margin, you need to bring it back up to the initial margin. Now, if you don't top up, the exchange will close the position and you're left with 100,000. And the short of the position gets that 100,000 to his margin account, and that's it. So, some few notes. Note number 1, the change in prices gets reflected in the margin accounts, which enables the exchange to guarantee the contract, or else it will close positions to prevent runaway losses from occurring, removing counterparty risk. Note number 2. Know that you can actually speculate using futures and make directional bets. If you think prices are going up, you can long the futures and take advantage of rising prices, and your margin account gains from the daily mark-to-market positions as prices go up. If you think prices are coming down, you can short the futures and take advantage of falling prices, again via your margin accounts. And all the profit and loss will get reflected in the margin accounts. So you have daily cash movements. And best of all, your cash position is not the overall futures position. In our hypothetical example, the futures position is 1 million, but note you're able to get positioned by this much using only the margin of $200,000. Which brings us to note number 3. Note that because of this means that if you want to track, for example, the S&P 500, you can synthetically track it by buying the S&P 500 futures instead, which correlates very highly with the spot market S&P 500. The advantage is that you only need the cash amounts for the margin account rather than ponying up the money at full positions. That is, instead of the 1 million in our hypothetical example, you only put up 200,000 and you already get the exposure to the underlying spot market. The only thing you need to figure out though is the hedge ratio so that you know how much of the futures you need to track on average to hit the underlying S&P 500. This is a summary of the futures versus forwards, and this is the big picture. Now, why does this matter in real life? Well, futures make hedging practical and scalable. Without futures, risk management will be slower, riskier, and less efficient. And because of how futures are engineered in practice, it can be used as an excellent means for speculation and for investment management purposes as well. So here's the takeaway. Futures didn't reinvent forwards, they fixed them by adding standardization, daily settlement, a margin system through a clearinghouse. Futures transform derivatives into safe, liquid global markets for finance, risk management, and investments. So, hooray for futures! That's all for today. Kindly like and subscribe to support the channel, and see you next time.